You're listening to the CEO Warrior Podcast, where more wealth, freedom, and market domination are only one step away. Hosted by business warrior Mike Agliero, owner of an over $28 million business, gold medal service, author of 4 books including The Secrets of Business Mastery, founder of the Warrior Fast Track Academy, CEOwarrior.com, and the CEO Warrior Circle Elite Mastermind, and publisher of Home Service Max magazine. And now, your host.
Hello, everyone, and welcome to the CEO Warrior Show. My name is Mike Agliero, Business Warrior, and this is the show dedicated to business owners, teaching you how to fast-track your business growth and give you practical, doable tips that you can implement today. Now, let's get started. Make sure you have a pen and notepad. Today, I will be interviewing Cody. Now, let me tell you a little bit about Craig before he comes on. One, we're going to be talking about tax planning and reducing taxes and keeping more of what you make. So I know you're going to be interested, so set some time aside right now. Craig is a certified tax coach, a certified public accountant, a business owner, and former New York City police officer with 17 years experience on the force. In addition to being a certified public accountant for the past 15 years, he is also a certified tax coach. As a certified tax coach, Craig belongs to a select group of tax practitioners throughout the country who undergo extensive training and continued education on various tax planning techniques and strategies to become, as well as remain, certified. With this organization, Craig has co-authored an Amazon bestseller book, Secrets of a Tax-Free Life. Without any further delay, Craig, how are you today?
Oh, Mike, I'm great. Thank you very much for having me.
Yeah, I'm excited to have you because I'm probably, I don't know if I'm like the norm or different, but I really don't enjoy paying taxes. Does that make me weird or make me like everybody else?
You're up there with about 99% of people.
That makes sense. So first, before we get started, why don't you just tell the listeners a little bit about what you've been up to lately?
I have a CPA firm, and we deal with business owners, and our primary focus really is when we meet business owners is we look for ways to help them keep more of what they make, meaning pay less tax legally. And what they're doing today that they could do maybe a little bit differently, but will have a big impact on the bottom line amount of tax that they actually pay.
Yeah, and I love that. And the important part is what you said. Like, I want to save as much tax as possible, but of course, I'm sure I'm like most, like, I don't want to go to jail, right? So I want to do it legally, and I also don't want to be run through the mill on anybody when I say this. Well, if you've ever been through it, I don't want to go through some kind of audit either because that's just a miserable month of your life. So why don't you get us started, Craig? What are some things you want us to just start to think about with tax planning in a business?
Well, one of the main things that people often overlook with tax planning is, they form a business. Okay, they either do it themselves or they call up an attorney. I want to form a business, and that attorney happens to like LLCs, or he likes corporations, or he likes S corporations or C corporations, and they form a business, and they're kind of locked into that entity. Nobody does any planning. Is that the right entity structure for me? Can I be doing this a little bit differently? Can I make changes? Will it make a major impact on my bottom line taxes if I do make a change? And that's probably one of the biggest mistakes we see, where wrong entity choice, just because there was no tax planning that went into it. It was just, they spoke with the attorney from a perspective of the attorney, that's the best entity to be in, and that was it. When sometimes you can have your cake and eat it.
Yeah, so when you say wrong entity, are we talking about an LLC or an S Corp and these types of things?
Correct. It could be, you may be an LLC when you're better off maybe being an S Corp or a Corp, or vice versa.
And give us a little bit of the differences between the different entities. So because I've always struggled with this myself, and I think what people might and you'll have to tell me if this makes sense or not. I mean, maybe if you start as an LLC, but maybe your business matures or changes to a different level or different ways, maybe there's a time where it might have to change. So it's kind of give us a high level but not very difficult description of the different entities.
So the main difference in taxation is on an LLC, all your net profit is subject to self-employment tax. And, that goes up to about $120,000 at about 15%, and then it's about another 3% on everything above that. Now, depending on your situation, an LLC may make the most sense for you, all right? But whereas an S corporation, if you take reasonable compensation, everything above your reasonable compensation is not subject to that self-employment tax. Now, there's a whole lot of things that go into planning, making that decision, and why one would make sense over the other. Could be what other businesses are you running? Do you own real estate? Okay. As people become more successful, they typically get involved in more and more things, and they may have other side businesses going on if they have real estate. Do they have passive income coming in? Do they have passive losses? Are they not taking advantage of it? And depending on the way they have the entity structured, they can take advantage of these things that they're missing out on.
Yeah, that makes a lot of sense.
Yeah, hopefully it wasn't too tight in there.
No, I think that makes sense a lot. And I think one of the big things that it makes me think is, you have to ask an expert the question, is the way that I'm set up the very best way now? I mean, some of the things my partner and I had learned over time was, and maybe you could help us understand if this is good or a strategy, is, sometimes if you have different parts of your business, you could have different entities actually have end year closings at different times to leverage things. Is that a strategy that makes sense in some cases?
I typically don't see where that helps that much, because if you have control, there's certain rules with picking up income, funneling income from one company to another. So a lot of times it all does even out without looking at the specific, structure and why it's done. But I think the key point you talked about was communication. The fact that people don't communicate with their accountants on a regular basis because, you don't know what you don't know, and they don't know what you don't tell them. But if you communicate, then you could figure these things out. And I'm sure you and your partner communicated with your accountant, and he had good reason to choose those different year ends.
Yeah, and one of the big things, Craig, for me about communication was, it was interesting. We were having lunch with our one accountant, probably this might go back 5, 6 years ago. And just during lunch, I mentioned to him, and this was the key that taught me about communication. I mentioned to him, hey, we're going to put this 120-foot flagpole on the front of our 15,000 square foot building in New Jersey, with this big, massive, it's got to be, 20 by 30 foot flag. And he turns around and says, what are you going to do? And I explained it. He says, do you know you could save on taxes from that because of something with the American flag or something like that? And I was like, no, I didn't know that. And so that was really good news. And that taught me a lesson that your accountant has to be what you consider part of your strategic team. And regular conversations make sense. You don't make big moves, big purchases without having this type of conversation. Have you found that that's the best way to work too?
That is definitely the way to work.
Yeah. So tell us, since we have a lot of small businesses, a lot of them are in the service style industry, doesn't matter if they're a dog trainer, a consignment store, or a plumbing business owner, what are some things they should either think about or some ninja tricks that they just may not know out there today? Okay,
well, they need to communicate with the attorney and their accountant, which we've already discussed. They need to take some time. I'm sure, you talk about working in your business all the time. They need to spend some time, working on a business as far as taxes go, and communicating with the accountant and seeing, okay, what can I change? Do I have a retirement plan? Should I hire my wife or my spouse? Can I hire my kids, and how does that help me by hiring my kids? Am I able to rent my home to my business and not pay income tax on that rent? Do I have a home office? Am I taking advantage of a home office? Do I have a partner? Does he drive a Maserati and do I drive, a Nissan Sentra? How do we equalize that? Do we use an accountability plan? So there are a lot of little things that you can do, and there are a lot of big things that you could do, such as retirement plans that can save you a lot of money.
Okay, let's start chopping into some of those things. So one, yes, you have to do tax planning, and I think it's tax planning by design instead of by default, right? And by default is waiting last minute, not talking, not communicating, and stuff like that. So I like that. Talk about some of these things like, can I claim renting my home? Let's start there. Give me, what could somebody think about, and when does it apply and when doesn't it apply?
So the government allows you to rent your home for up to 14 days a year and not pay income tax on that income. So your business can pay you personally to rent your home for, let's just say, 14 days a year. They could be 14 board of directors meetings. They could be staff functions. They cannot be entertaining clients. They have to be strictly for your board of directors and your staff. And what that does is it gives your business a deduction for whatever the reasonable rent is. And then personally, you don't have to pay income tax on that rent because it's less than 14 days. Now, if you go to 15 days, you have to pay tax on all of it. So you need to be careful that you don't do that.
Okay, awesome. And before we go further, I want everybody to know, just so all the listeners know, no matter what you hear, you have to do your own due diligence, okay? We're giving you, Craig is giving you suggestions from his wisdom, but of course, I don't know where all of you live. You might live in New Zealand or Australia or some other part of the world. I don't want to see you get into some tax complications, so I want you to know all the suggestions we're making are for you to run by a tax expert, even if you choose to do business with Craig and reach out to him. So there is my disclaimer for everybody. Do your due diligence. Okay, go ahead, Craig. Pick that back up.
Thank you for the disclaimer. So that's one thing that is a very popular technique, which in a state like New Jersey, income taxes are high. Federal tax rates are high. That could save you, 40% of whatever reasonable rent is. And reasonable rent can be anywhere from, I know I have a client where she rents her Brooklyn brownstone to a movie studio and she gets $5,000 a day. Now, is that the norm? No. But in her case, she saved tax on $5,000. Another thing is, using the home office. Do you have a space? And, most of us, we take work home at night. Okay, we work from home. Do you have a space that you use exclusively for your business to take care of, administrative tasks? If you have that space, go ahead.
Yeah, go ahead. How much, what can you claim and what's the restrictions around that space?
So you have to look at it from a square footage. Let's just use the number 10%. If it's 10% of your square footage of your home, that means you get to deduct 10% of your utility bill, 10% of your real estate taxes, which you would deduct anyway, but if you're subject to alternative minimum tax, that can help there, 10% of your mortgage interest. Then your commute becomes an expense. You can also then have a home athletic facility. So if you have a home gym, that becomes deductible. If you have a home pool, that becomes deductible if it's for the use of your employees and their families. So there's a whole host of add-ons that go from that. And these are all in the tax code. And when we do a tax plan, the plan includes the code that says where you can do that. These are not gray areas.
Yeah, no, I love the way that sounds. So let's go to the next one. Let's talk about hiring the kids. I've heard this before, and so why don't you shed some light on What can you do? What should you never do? And what should you consider?
Okay. So the tax court says you can hire your kids from the age of 7. All right. I like to be a little bit more conservative. I look at 11, 12 as the minimum age that will advise clients on that. And then the child actually has to do some kind of work. He has to come in, whether it's on Saturdays for a couple of hours, and he's got to, clock in or sign in and keep good records of his time. And then let's just say your child goes to summer camp or a private school or takes hockey lessons or something like that. You pay the child, it goes into his bank account. Then the hockey lessons or the camp or the private school tuition comes out of his bank account. So other than Social Security tax, that money then becomes, deductible. Well, the whole thing is deductible, but other than Social Security tax, the business owner is not paying tax on that money, which he's using to fund, his child's, whether it's tuition or camp or athletic events.
Yeah, and I mean, Craig, that could add up really fast today. I mean, it's not like, when I was a kid, the things you did was, I don't know about you, but it was like go outside, pick up sticks, go play with your friends and ride bicycles. Today it's like you take them to dance school, and then there's martial arts, and then there's hockey, and then there's football, and then there's baseball. It's like it's a full-time profession to take kids to all the different things today. So that could really be a huge savings there.
Oh yeah, I had 3 kids in private high school, and it was over $18,000 a year. So you figure your tax on $18,000, what you're saving, and if you do some planning and you have the right entity structure, you may not even have to pay FICA tax.
Wow, that's interesting. So you brought up about partners and stuff like that. So, and about making sure things are balanced out, which I think maybe some people do, but is there anything else around partnerships that helps you leverage taxes?
Well, when I talk about partnerships, I'm talking about really partners in a business. So me and you like to drive 2 different types of cars, but maybe you have more of other expenses, so you want to be reimbursed for those expenses, and I want to be reimbursed for my car. And we decide, okay, we're going to work out a number of $500 a month. So now every year I need to submit to the business that 500 times 12 is $6,000 worth of expenses, and I'm going to get a check every month for $500. If I don't submit the $6,000 worth of expenses that are deductible, then I actually have to pay that money back to the firm. So the key there is to make sure everybody's on board, keeps track of their expenses, and then you can spend it on your car and I can spend it on other things that are business expenses, but we like to do it differently. Maybe you do a lot more entertaining than I do.
Yeah. Talk about, that makes sense. Talk about deductions for maybe, is there things around food, or is there things around vacations? And I'm asking because I don't know. So give us some other areas that we can claim some things.
So meals and entertainment are deductible at 50%. So if you take a client or prospective client out for lunch or for dinner, the government says you could write off half of that cost. Now, if you provide meals in your office for your employees, so let's just say they can continue working at their desk, that deduction becomes 100% deductible because it's really for the convenience of the employer versus the employee. So those are meals and entertainment that are deductible in different ways. Another thing we come across quite often is we have these successful business owners and they're supporting their parents, and they're giving them $2,000-$3,000 a month. And how do you make that deductible? Okay, you can't put them on salary because they're not working for you. That would not be legitimate. But let's just say you have a piece of equipment in your business that's fully depreciated. You could then gift that piece of equipment to your parents, and then you lease it back to them. So now the money you're paying towards that lease, they're picking up as income, but they're really not paying any income tax because their income is so low, and you're getting a deduction for the money that previously you were just giving to them and paying after tax. So that's another big savings area. And
so you get the deduction and they get the money.
correct. And typically their income is low enough that they're really not paying any income tax.
Yeah,
or if they are, it's a very low amount versus you who's probably in the 40% bracket.
Yeah, I don't. Sometimes I think that I'm proud of that, and sometimes I think like it's miserable, right?
Yes.
One accountant, Craig, told me a long time ago. I mean, Rob and I, my business partner, we've been successful a long time. He said, "Well, you don't like to pay the taxes, but let's look at the opposite of it. What if you made no money at all?" And I was like, that's a good damn point. It still doesn't make it fun to swallow, but it's a good point.
Right, but why should you pay more than you're legally responsible to pay? If Warren Buffett, Bill Gates, Donald Trump, presumably all have tax planners that work to limit the amount of tax they pay, even though they may pay a lot of tax, but they pay the least amount that they're legally liable to pay. Why should not you do it?
Yeah, I agree with that 100%. I mean, that's really great information to be used. Okay, so where else are there some areas that business owners, we covered, rent and home and kids and meals, and I think the meals for the employees is a real interesting thing, and you could give things to parents. What are some of the other top 10 items that you're like, you know what, clients just don't know about this business owners, and they really should because they're giving money away? What about like 401k or retirement, stuff like this?
Retirement plans, is one area where you can set up a 401k, and there's a minimum amount you have to contribute for your employees. But if you're able to put away $18,000 or $24,000 a year from payroll deduction, and maybe if you hire a spouse and they're able to do the same thing, you're able to put away $50,000 that you wouldn't be able to do if you had a plan. Another thing that we see, especially with service business owners, when they buy an existing business, part of the actual purchase price gets allocated to something in the accounting world called goodwill. And so many times we see goodwill doesn't get amortized or depreciated when it should, and that could be a big number. Or doing some planning with equipment and purchases and vehicles towards the end of the year. Am I in a position, do I need something? Am I in a position to buy something? What's the tax effect? Should I depreciate the whole thing? Should I take bonus depreciation? Should I take it over time? Which could be a lot. And then you have the business owner that actually goes out and buys the building that he operates in. And has he maximized his deductions there?
Yeah, talk about, because I own a couple buildings that I run different businesses out of. What are some things that you can leverage from those buildings?
Well, one thing is typically commercial building, you depreciate over 39 years. And more often than not, somebody buys a building, you subtract out the land price, whatever's left, they depreciate over 39 years. But if you take some time and you have a cost segregation study done, what they do is they break that building into different sections, the land, the landscaping, the parking lot, the heating and cooling system, and then they could depreciate these items quicker. And what that does is it actually accelerates the amount of depreciation you're allowed to take in the earlier years, which gives you a bigger tax deduction up front versus taking a little bit every year. So that's a quite uncommon or common thing that we see not happen.
Yeah, that's interesting. I'm definitely going to look into that one myself. And what about business owners? A lot of times it comes up, should I buy a building? Should I not? Another thing is, should I get a credit line? Should I not? Any tax strategies around what somebody should consider that's running and growing a business?
Well, I mean, as far as a building, what am I paying in rent? What's it going to cost me to own an asset? What's the, after tax cost to me? So that's a big question. And obviously, more often than not, it's going to make sense if you can afford it to buy the building, because rents only go up over time. And if you're renting from yourself and you're increasing the rent, at least you're putting that into your pocket versus somebody else's pocket.
Yeah, that makes a lot of sense there. And talk to me about accountability plan. You said you got to have an accountability. Accountability to what?
Well, the accountability is that you're going to provide those receipts for the total amount of expenses that you've received throughout the year. And if you're not accountable, meaning you don't provide all those receipts, you actually have to pay back that portion of money that you received back to the business. So something that is a tax deduction to the business would then not become a tax deduction.
So you have to make sure you have a good process in place for how you're spending, where it's going, and how you're allocating things. Have you found that there's a software or something that makes that simple, like, hey, this is what this is, and puts it in buckets for you automatically?
We don't have any specific software we work with that on. We with our clients, we just communicate with them and make sure they're on track to do what they're supposed to do, and we kind of make sure that those T's are crossed and the I's are dotted. Because face it, your clients, they're working, they're making their money in their business. They don't want to be that involved in, worrying about what they need to do as far as tax planning. They have to do something, and we're there to remind them for the things they need to do.
Yeah, that makes a lot of sense. So what else should people think about, Craig, when they're going about either doing tax planning? Like if I called you up and I said, hey, Craig, I need to get my taxes under control and figure some things out. Run us through what a plan might look like. What would you ask me? What would we want to know? Like, how does this process go about?
So for us, the process works with, we have a conversation, just like we're doing now, and I learn about their business. Then I ask them to send us securely copies of their last 2 years' worth of business and personal tax returns. During that initial conversation, I find out, has anything changed since your last filing? Have you bought a new business? Have you bought any new real estate? Has your business expanded? We take all that information and we do an analysis, and then in our case, we set up a WebEx meeting where we go through that analysis and we say, okay, we see $60,000 worth of missed expenses that you could have. You're in a 42% rate between federal and state. That's going to save you $24,000 a year in taxes. Do you want to move forward with a plan? We tell them what the fee for the plan is, what the after-tax cost, what the first-year ROI is on that fee, and that our fee is 100% refundable and nobody's ever asked for their money back because it's instant gratification. If they move forward, it takes us about 10 days to put together a plan. We set up another WebEx, we go through the plan, and then we take it from there and we communicate. We make sure that they implement the plan. Sometimes they implement it with their own accountant. Sometimes they say, you know what, I haven't been happy. I've been bouncing around. He's a nice guy, but can we work together? And then we take it to the next step. But we do many plans with people where, their tax guy happens to be their brother-in-law or a longtime friend, and they need to maintain that relationship. So we give them all the tools they need to take this to their accountant and implement it, or we help them implement it.
Yeah.
It's a
let's talk about.
I'm sorry. It's a relatively painless. It's a relatively painless process.
Yeah.
And
so so I think there's three brackets of people in business, and since we have business owners, Craig, I want to talk about it. So one, you have people. I think we covered a lot of this, like, hey, I'm in business, I'm running a business. So let's bracket the two other things. Like, one, I'm growing a business, so people are in growth mode. What are some things they should pay attention to with taxes and leveraging things when they're going into massive growth mode?
They want to make sure that their receivables aren't growing too fast. It's great to sell, but you also need to get paid, and that's something that they need to track. because that could quickly put you out of business. And it's, quite often in the, construction trade, you see that where people are running these businesses and they have all this money out on the street. And then eventually, the money doesn't come in, they can't make payroll, and they're closing the doors. So you want to make sure that doesn't happen. You also want to make sure that you're getting paid and you're getting paid timely.
Yeah, that makes sense. And then what about people that we work with a lot of guys that are positioning their business for either, exiting or exiting, they might be passing it off to a child, or exiting, they might be getting acquired. So they have an acquisition of some kind where they're selling. What are some tax strategies that they should pay attention to around that?
Well, we work with clients that are in that process, and we provide them with what we call our outsourced CFO service, because you want to make sure everything is, real clear for the purchaser to understand. And you also want to be able to come up with a clear layout for that purchaser. Let's just say net income on your tax return is $500,000, but maybe you're doing self-rental, you're doing a bunch of things that he necessarily will not need to do, and I call these add backs. And we add these back to the bottom line, and that justifies a higher multiple of your net income.
Yeah.
So
those are important things.
It's incredibly important when you're in that stage where you are selling or looking to sell that your accounting is really up to snuff, and you're not just dealing with somebody at the year end who's being reactive versus proactive.
Yeah, I noticed a lot of clients there, and I'm wondering if you see that too. They're very reactive. Like all of a sudden it's, right before tax time, and they're running around like they're like a chicken with their head cut off. And would you say that is just bad planning, or maybe they just haven't looked at their accountant as, we've always looked at, me and my partner always looked at, we've always had a strategic accountant, we've always had an attorney. These were very important parts to us building our $30 million business that we run, was to make sure we had a solid team of experts. So have you found that the people that are running into trouble in business, it's because they have not built that relationship of a team?
Most definitely. You need to plan. You need to be proactive. Most accountants are really good at putting the right numbers in the right boxes. Okay, that's not where they fail. But they're always looking in the rearview mirror. And with our clients, we work with our clients throughout the year. So you can't just come to us at the end of the year and say, okay, I'd like you to do a tax return for me, or I need you to fix my books and we'll see you next year. That doesn't fly, because that's not fair to the other clients. And you're really doing yourself a disservice. So you need to work with whoever you work with on a regular basis. That makes so much sense. And I agree with you on the rear view mirror part, because I've experienced that years ago myself, where, I felt like the accountant was just always looking back instead of forward. And also, I would imagine you want to make sure your accountant has a business sense to them. And like you said, not just someone who puts numbers in boxes, because, they'll get the number in the box, but it's probably going to cost you money, versus a really good accountant shouldn't cost you money. They should make you money. Exactly. It should be a profit line item, not an expense line item.
Yeah, definitely. So what else can you think of that comes to mind, a couple more things before we close out this episode, that you're just like, you know what, everybody should really consider this. They really should think about this. You really should pay attention, or maybe another strategy that you think you haven't shared that they just don't know about?
I shared a lot of the basic strategies. There are others, but I think, the best thing your listeners can do is they should communicate with whoever their accountant or tax person is on a regular basis, and they'll get so much more by doing that. And then if they find that their particular person is not willing to communicate with them, then they need to look elsewhere. But, like you said, they should be part of the team. Like you said, the people that are successful have teams. People that are successful typically involved in coaching programs. So they need to just follow that along.
Yeah, I agree with you 100%. Now, for one big last question for you, Craig, is if you were to give everybody something to think about, to really pay attention to over the next 3 years as a business owner, you should really think and pay attention to this. What would you tell them to pay attention to?
I would say pay attention to your expenses. What are you spending money on? What are you spending money on that you don't necessarily need to be spending money on? Chasing the old shiny object. All right? And to also think about, a typical person is going to save about $20,000 a year if they do tax planning, whomever they do it with, and that's $60,000 in savings over 3 years. What would they do with that money if they saved it?
Yeah. So it's not only save the money, what are you doing with the money that you're saving? And do you have any suggestions on what people should consider doing with the money they save today?
Well, they should save it. They should do something that, they want to do with it, but that could be purchasing a building that they're operating. Maybe it's a rental property. It really depends on what their lifestyle is. Do they want to, put more money away for retirement? Do they want to put more money away for their kids' college education, their grandchildren? What is it that's going to, it's kind of like their why. What is it that's going to make this really most pleasing for you? Because if you don't do anything, you're not going to miss it. But if you have it, you want to do something special with it.
Yeah, that makes a ton of sense. Now, Craig, a lot of people now, they've been listening to us here. They've got tons of golden nuggets. They realize there's a huge opportunity here. How would people find out more about you? Okay,
our website is CraigCodyandCompany.com. That's all spelled out. I'm also going to give you a link for your show notes where your listeners can get a free paper copy of my most recent book, which is the 10 most expensive tax mistakes that cost business owners thousands. And that link is CraigCodyandCompany.com/warrior. And our office number is 516-869-4051. And, we have clients I'm in New York. We have clients as far away as Oregon. The internet is a wonderful thing.
Yeah, that's awesome. Well, Craig, I can't thank you enough for today's podcast. You've given us a lot of nuggets. I know for sure some of you listening have just made yourself some money. So, thank you, Craig, for being such a great guest today.
Well, thank you very much for having me. I appreciate it.
All right, awesome, everybody. We don't leave without some big golden warrior nuggets. So make sure you're making the right choice on your entities that you're filed with, and communicate and treat your accountant as part of your team. And tax planning should be done by design and not by default. And guess what? You can rent your home up to 14 days a year and just make sure it's a staff function and then claim that as a deduction. And what about a home office, right? You could claim that based on the percentage of your mortgage and stuff, and you could claim that in commuting expenses and even a home gym. So I think there's even some more money to be found there for you. And maybe you got to consider, some of you, hiring your kids and then using some of that money and funds to pay for all those hobbies your children have. And what about meals and entertainment, right? Deductible 50%. So maybe one of you want to hit me up and take me to lunch, and meals for employees are 100% deductible. So I wonder if there's a strategy there for you to create more retention of employees and maybe a more wow atmosphere for your employees to work in for the culture. And you could give things to your parents, then pay it back to them, and you can deduct that. And guess what? You're giving them money anyway. You might as well find the best way to help your parents out. And retirement plans. Are you leveraging 401k the proper way? Maybe you got to start putting that on a checklist and look into that. And when you buy an existing business, you can claim certain areas as goodwill. And remember to leverage the end of the year buying things. Don't get caught off guard, okay? And I love this one for any of you that own a building. What about the cost segregation study done? And then depreciate things for the building quicker and take it in the earlier years. And just a few more golden nuggets for you guys. Make sure you have great records and receipts. You're going to need that to back up all the deductions you're going to do. And pay attention to your receivables. You don't want to wake up one day and find out you're way underwater and drowning. And last, which I think is an awesome one, pay attention to your expenses. Well, that's it for this episode of the CEO Warrior Show. I'd also be grateful if you'd rate my show on iTunes. That helps tremendously with keeping my show visible so people who have never heard it can discover it. If you have already done this, thank you so much. I'm very grateful. Be sure to connect with me on social media. It is a great way to ask me any questions or offer feedback on the show. Until next time, remember, massive wealth, tons of freedom, and market domination is only one action step away.
This has been another powerful business building episode of the CEO Warrior Podcast Show with your host, Business Warrior Mike Agliero. Ready to experience real ideas, real change, and real success in your business? Check out the Warrior Fast Track Academy at warriorfasttrackacademy.com.